Good morning. Welcome to Trading Hour. It's a brand new week. I'm Reema Tendulkar. With me is Pavitra Parekh, and things have gotten off to a quiet start. The Nifty, as we speak, is holding above that 18,500 mark, so above the 20-day moving average. And there has been a sharp recovery from the early morning lows. So the market started downbeat, and that's because the Nifty IT index opened with a cut of nearly 1.5%. But since then, the IT index has recovered close to about 1.5%, and that's mirroring the recovery that we're seeing in the Indian markets. Thereafter, in the last 1 hour, things have been fairly quiet. Remember, this is a major week of central bank action. So ahead of that, we are seeing muted moves across the global markets. Right now, pretty flat on the benchmark indices, just up close to about 0.1% on the benchmark indices. The advanced decline ratio right now is in favor of the gaining side. So we've got about 4 stocks in the green for 3 in the red.
Hi, good morning. So like you said, we've made quite a big recovery, especially if you take a look at what's going on in the context of the rest of Asia, right? So Hang Seng at one point was down 4%. It has recovered. It's currently around 2.5 points lower. You have Taiwan also on your screens. And a lot of the Asian markets are seeing cuts after that weak handover from Wall Street. So do keep that in mind. For our own markets, what's holding up quite well today are some of the larger auto names. So the likes of M&M, Hero, Tata Motors, these are some of the top gainers on the Nifty. You also have the HDFC Twins doing quite well. So take a look at those as well. On the downside, HCL Tech, after opening well in the green, has actually seen quite a slip, and it's pretty much, it's back in the red right now. After we did speak to the management, the rest of the IT pack also finding itself there. In terms of cues, the CPI data from the US is on 13th, so that is something important to watch. And then, of course, the Fed decision, which will come out on the 14th, that is Wednesday. So that's something that you should keep your eye out on as far as cues go. But for now, let me run you through everything that we have lined up on the show today. The market trades flat after slipping in early trade. Mid-caps fare a tad better. Autos and metals show strength. IT slips. We'll discuss the market fundamentals with Rajesh Baheti of Cross Seas Capital Services. And IT services companies are in the spotlight amid global slowdown concerns. HCL Tech's management, meanwhile, tells CNBC-TV18 that high furloughs are not unique to the Noida-based company. Key management commentary coming up later on the show. We'll also take the discussion on the IT sector forward with Girish Pai of Nirmal Bang Institutional Equity. So stay tuned for that conversation as well. And it's a muted debut for Uniparts India on the bourses today. The stock slides after listing at a slight discount to the issue price. More details in just a bit. And India's largest winemaker, Sula Vineyards, 960 crore rupee IPO opens for subscription. Key excerpts from our conversation with the management also lined up for you. So all of this and lots more over the next 60 minutes.
But first up, let's talk about the IT sector. Now, HCL Tech spooked the markets on Friday. The stock was down 7% after the company said that growth is going to be at the lower end of their guided band of 13.5% to 14.5%. So earlier today, we had a chance to chat with the management of HCL Tech. We asked them what changed in the last 2 months. The company indicated that we are seeing higher furloughs in a couple of verticals like BFSI, telecom, high tech. That's what changed, which is why growth is going to be slightly lower than what we had anticipated. We also went on to ask that how many clients are impacted. Is this just a few select clients where things are a little worse or stressed, or is this broad-based? To which the company said a handful of clients are seeing higher than expected furloughs in the December quarter, about 3 or 4 of them. But this could be an industry-wide phenomena. It doesn't appear to be unique to HCL Tech. When quizzed about the margins, they're saying for FY23, the margin guidance remains at 18 to 19%, but their aspiration is to improve the margins to 19 to 20%. So listen in to some of the key excerpts from our conversation with the MD and CEO of HCL Tech, C. Vijay Kumar.
It's maybe 3 or 4 clients in these verticals. That's what I would say. However, one should keep in mind, we did talk about the bookings. We expect to have a decent booking. The deal momentum is very robust, especially the vendor consolidation and the cost efficiency led deals. Currently, our guidance is 18 to 19% for this fiscal, but our aspiration is to get back to the 19 to 20% range as we move forward. So good deal momentum and good progress on all the cost levers that we have been working on. No, I mean, half the year is over. You know what the first half margin profile was. We will do better in the second half. We had a good benefit of realization in the last 6 months based on all the billing rate enhancement that we were driving. But moving forward, I think getting increases may be difficult. But I expect the pricing to be stable because still for some niche skills and some of the newer skills, the demand is quite high. So I think the pricing I expect it to be more or less stable as we move forward.
Okay, also saying that pricing increases from here on appear to be difficult. On the whole, it will be fairly stable. To talk about what 2023 looks like for the IT sector, is this going to be an industry-wide phenomenon? We're now joined by Girish Pai of Nirmal Bang Institutional Equities now. Girish, morning. Rima here. First, your key takeaways from the HCL Tech Investor Day, which took place on Thursday midnight, and what the management had to tell CNBC TV18 and the implications for the rest of the IT companies.
Yeah, first of all, thanks for having me on. So I think what HCL Tech is indicating that second half is going to be challenging, probably a bit more seasonal than has normally been the case. So last couple of years, if you discuss FY22 or FY21, we've had 3Q and 4Q to be reasonably strong, whereas we're going to go back to the seasonality situation that the industry has generally been facing pre-pandemic, and more so now because we have macro headwinds that the customers are facing, and they are, at least some of them are, instituting larger furloughs as we speak. So 3Q is going to be probably a little bit more weaker than what the street was anticipating. And I think it's going to be an industry-wide situation because some of these customers who are instituting these larger furloughs are probably going to be, are working probably with the larger vendors across the industry and not so much HCL Tech specific. So that is something that in the very, very near term, I think from an FY24 or 2023 perspective, we are among the more cautious analysts in the street. We are expecting, low single digit to mid single digit kind of revenue growth in US dollar terms. I think my peers in the industry are working with high single digit. I'm working with a situation where there's going to be a little bit of margin, a little bit of pricing pressure coming through in FY24. So just as the HCL Tech CEO was kind of mentioning that it's getting more difficult to get price increases, or the price increases are far more selective now than they used to be like 6-9 months back. My take on that is that as we move into 2023, we will probably see customers kind of push back on pricing, and we'll see some pricing cuts come through, or the mix change is going to probably result in some of the price decreases that I'm kind of instituting. So I'm fairly cautious on FY24, and from a structural perspective, my sense is that industry is probably going to grow at maybe 100-200 basis points faster than, say, the 7 to 8% growth we saw pre-pandemic, versus probably my peers working with maybe 400 to 600 basis points faster growth. So probably that's the kind of construct I have. I'm fairly cautious both from a near-term perspective as well as from a structural perspective.
All right. Hi, Girish. Good morning, and thanks for joining us. This is Pavitra. So, you were mentioning that this is not likely to be an HCL Tech specific problem. It could, span the entire industry. What is the kind of growth rate that or decline in growth that you would pencil in for some of the larger players, the likes of Infosys? And also this pain that you're talking about on the furloughs, of course, and also the pricing situation. How long do you think that's likely to last? So, I mean, all of this year and then all of FY24 as well?
So I think industry tier one stocks would probably grow in the mid-teens territory from a US dollar perspective for FY23. I'm expecting, a step down from that kind of rate of growth to like 3-4-5% kind of growth in FY24. So that's the kind of decrease in growth rates that I'm kind of looking at. And as I mentioned, I'm in my models, I'm kind of instituting about a 2% kind of a pricing decline, which is not very, which I think is fairly generous. So my base case is that you're going to see a shallow recession in the US in 2023. That's an explicit call that I'm taking. My peers, my competitors on the sell side are probably implicitly assuming that's going to be a soft landing, so to speak, which will probably not mean a pricing decline. So I'm assuming a pricing decline, and that would mean Margins will probably remain flat at best. I don't think they're going to improve. Yes, there are various other levers to improve margins into FY24, especially on the employee cost side, and there could be more offshoring happening. But I think a couple of things that will probably go against any material margin increases next year would be one, pricing compression. Second is, I think this is a unique situation which we've not faced as an industry in the past, even in past recessions, which is that the on-site costs will probably go up even in FY24 because the situation on on-site supply it seems to be fairly tight at this point in time. So broadly, that's the construct I have.
So you're saying margins could come under pressure because pricing is likely to decline by 2% and on-site costs are going to go up. So is the street overestimating margins, and what could be the downside risk?
See, I'm not really, my sense is that FY24, we're going to see probably flat margins. So obviously there are both puts and takes to the margin situation. So on the positive side, my sense is that you're not going to see the kind of salary increases you've seen in FY22 or FY23. So that is one positive. I think utilization can move up. I think some of the cross-currency headwinds that were there may probably not be there in FY24. But on the other side, on the negative side, my sense is that pricing could be a bit of a challenging situation versus the flattish kind of expectation that my peers have on the street. I think pricing could probably come under pressure. I'm taking just a 2% kind of a decrease. It could be much larger if you go back in the GFC timeframe or in the post.com timeframe. You saw mid-single-digit to high single-digit kind of price compression happening at that in those situations. So I'm not assuming the worst case here. And the on-site salary increases, I think, could be material. I mean, it could have material impact on margins. So I would say those are some of the things I'm working with on the margins. That's all. I'm not assuming a margin compression vis-a-vis FY23, but I think we're going to see flat margins.
All right, got that. That is on the margin front. Girish, within this space, I know you're underweight IT, but within this space, do you have a preference for either the larger names or the mid-cap IT stocks?
Yeah, so tier 1 is what I prefer versus tier 2 because tier 2 I think will come under greater pressure because of vendor consolidation and my sense is that as the tide kind of goes away, I think the tier 2 players are going to feel a lot more pressure because there is a lot more client concentration, vertical concentration, service line concentration that these companies have, and therefore their businesses are not as diversified as the tier 1 guys are. So I would think that there's going to be more both P multiple compression and earnings compression that tier 2 companies are going to face. So my preference is more towards tier 1, and within tier 1, if you were to ask me, I would probably rank TCS, HCL Tech, and Infosys in that particular order as my preferential set of companies to invest in.
Have you heard similar commentary about higher furloughs from the other IT companies in your interaction, Girish?
Not really, Rima, because what typically happens is in between quarters, companies really do not come out and see anything very incremental. They just stick to the commentary that they've given in the results, the previous results season. So I think one of the data points to watch out for would be the Accenture results, which are going to come out, I think, on Friday, the coming Friday. And one of the things I would watch out for is whether they're going to change the guidance. So if I look at the guidance they've given for the current year, that is about a 7% organic YOY growth, which is more front-loaded. And I would kind of watch out for whether that number is going to go up. And whether there's an implication in terms of whether the 2H FY23 kind of number for Accenture is going to move up. And if that is the case, I would probably think that could imply some positive that may have positive implications for the Indian industry because their 2H is equal to our 1H in one sense. So that is a data point to watch out for. So that's coming up on Friday.
All right, Girish, we will leave it at that. Thank you very much for joining us and taking us through your call on the IT space. That was Girish Pai talking about, this entire furloughs problem that HCL Tech pointed out, saying that it is likely to be an industry-wide problem. We could see a decline in growth of around 2%, and that is what it is looking like for the full industry right now. But with that, we're going to get into a short break. When we come back, we're going to shift focus from the world of equities and talk about commodities. Manisha Gupta will be with us. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC TV18. A space that has really picked up in the past few minutes is the metal sector. In fact, that is the top gaining sector on right now in terms of sectoral indices as well. So a lot of these stocks, the likes of Hindalco, Tata Steel, you have JSPL, all at the high point of the day. So do keep your eye out on that. And the PSU banks have slipped a little bit. But let's talk about the commodities now. Manisha joins us, and today she's actually going to tell us about metals itself. Manisha.
Oh, well, yes. Thank you for that, Pavitra. I mean, when you look at the non-ferrous metals, I don't see copper, aluminum do so well. I mean, they are not trading as firm as the ferrous metals are trading. So when you look at the steel prices, we are trading at a 2-month highs for this one. The iron ore prices are trading at a 4-month highs. Actually, when you look at the last week itself, the steel prices gained up by 4.5% and iron ore prices gained up by 6%. And we have seen strong gains continue into Asia today as well. Well, the reason that you're looking at support is that China in the last couple of weeks has done a lot in the sense of liquidity injection. They also have cut the reserve ratio. There is a lot of stimulus that is being pushed out or pumped into infrastructure and real estate projects, and that clearly seems to be supportive. So markets are getting ready for the Chinese demand to come back. There is still weak demand that you see coming in from Europe, but the Indian infrastructure and the US infrastructure sector also seems to be doing quite well, and that is what the markets are counting on at this point in time. For the Indian markets, even as we are looking at the construction and the auto demand to start picking up, the rest of the sectors are not doing so well. And in any case, India is looking at competition right now from the international markets. The export numbers do not seem so good, and the Chinese demand, it is a Chinese hope premium that we are looking into the markets right now. On ground, very strong demand is yet to pick up. So as of now, it is majorly sentiment. We have seen a lot of short positions being closed, and that clearly has been supportive. That is the data that has come in from World Steel Association, where they are looking at, when you look at the steel demand itself, China has seen a decline, so has European Union. So the overall global demand for this year is estimated to decline between 2.3%. But the World Steel Association also believes that next year it could be a positive, even a smaller 1% of a jump in demand, and that is what the markets are latching on to. If you also look at the steel production for 2022, we have seen a decline come in from China and European Union. Even the numbers coming in from US are not so great, but India has seen 6.4% of a jump up coming in for this year itself. Going forward, it's all going to be about the US inflation numbers and the US Fed meeting in the next couple of days. But today, what also is supporting the metal prices is that the dollar index is just about holding 105. Very flat trades coming into that one ahead of the US Fed meeting, and that seems to be supportive too.
All right, Manisha, thanks a lot for getting us that entire roundup of the metal space. For now, we are going to take a short break. But like we've been telling you, it is quite flat for the markets, but it's been an over 150-point recovery from the low. So when we come back, we'll discuss the market technicals and tell you how to approach the screen on a day like today with Rahul Mohinder. And we'll also get you some of his top bets.
Welcome back. Things are quiet on the benchmark indices. Rahul Mohinder of ViraTechIndia.com joins us now for a quick technical check. Rahul, your thoughts on the morning so far? What have you made? Any trends? Any trading ideas that you would recommend?
Good morning. I think, first of all, on the Nifty, 18,600 is a major hurdle. And I think despite the fact that we've corrected a good 500 points over December, it's nothing in comparison to the 2,000 plus point rally we saw over the last 2 months prior to December. So I think at this point, my sense is that the index is mostly sideways to down. Keep 18,600 as a benchmark on the resistance. Unless we cross that, let's not start initiating new long positions. I mean, within the index, what worries me is Reliance, which continues to be, looking weak. I think today, if 2610 breaks on Reliance, I would sell it for a 2575 target. 2640 is a good stop loss to be working with when going short on Reliance. Another two buy ideas that I have, which I think could just buck the overall sentiment, would be ITC and BPCL. So ITC can be bought with a 338 stop loss. If you're looking at very near term, 347 is the target, but finally, I do think 352 is likely to come in. Another one is BPCL, which I mentioned. 334 could be your stop loss. Keep a target of about 348 on the stock. These two look fairly good. They've consolidated some good volume as well coming in.
All right, Rahul, thanks a lot for getting us all of those individual ideas. But with that, let's also move on and talk about the new listing. It was a muted debut for Uniparts India on the bourses today. The stock slides. It's around 4% down after listing at a slight discount to the issue price. So Surbhi is here with the details. Surbhi?
Hi, thanks for that. So Uniparts made its debut on the stock exchanges today and it's all muted listing. It was listed at 575 rupees per share versus an issue price of 577. Now the company is a manufacturer of systems and components for the off-highway market segment in the agriculture and the construction division. They manufacture 3-point linkage systems which contributes 58% of their revenues and they have a market share of 17%, and they also manufacture precision machined parts which contributes 36% of their revenues and they have a market share of nearly 6% there. They also manufacture some adjacent products like fabrications and power takeoff. Now most of their revenue comes from the export markets, where exports contributes nearly 87% of their revenues and domestic is the 13%. They have 6 manufacturing facilities and 3 warehouses. For FY22, they made a revenue of 1200 odd crores versus with an EBITDA margin of 22%. On valuations front, it is valued at 15.2 times FY22 PE versus their other listed peers, which is valued at anywhere between 19 and 36 times FY22 PE.
Okay, Surbhi, thank you very much for that. We'll get into a break. On the other side, we'll discuss market fundamentals. Rajesh Baheti of Cross Seas Capital Services joins in next.
Hi guys, welcome back. You're still tuned into Trading Hour. The market has slipped once again. We're back in the red, just around 3 points lower right now, but we are back in the red. The mid-cap index has also slipped quite a bit, just at the flat line right now. And the Nifty bank has also given up a little bit of, the gain that we were seeing over there. So it's around a 40-point gain that we are seeing on the Nifty bank. The PSU banks have actually slipped the most within this pack. So that's what's going on with the markets. But let's now get a conversation going as well. Let me invite Rajesh Baheti, who's Managing Director of Cross Seas Capital Services, on the show now. Rajesh, good morning. Thank you very much for joining us. This is Pavitra. And just to begin with, we've been talking about this huge outperformance that the Indian markets have clocked in, the kind of resilience that we have seen. But the valuation concerns have also been going up. Do you think we've seen the highs, at least for now?
Absolutely. In absolute terms, also our markets are now reasonably valued at a premium to our own history. So that's the first problem. The second problem is on a relative basis. We're way out of whack in terms of anything that you've seen in the last 10, 15 years. We do trade at a premium, but the premium now that we trade at is completely way out of whack. China is maybe half the valuation of India. So at some point, the FPIs and the foreigners will begin to wonder if it makes sense to put that additional dollar into India, or whether if China opens up, and there are signs that they are, that China and other markets will appear more attractive.
Rajesh, hi. Just about this MSCI India versus China. MSCI India has underperformed MSCI China by nearly 25% since October of, 31st October. But since March of 2020, India has outperformed China by 260%. So some of that outperformance has started getting reversed. But let me introduce Sonia as well. She joins us on the show. Hi.
Hi, Rima. Hi, Pavitra. Thanks for that. So, Rajesh, I just wanted to ask you, and good morning to you as well. It's very quiet for the market today, but one thing that has stood out for the last many days is the weakness that we've seen in the technology space. And in that context, companies like HCL Tech, although they have scaled their guidance lower, they are not too alarmed by the situation at the moment. A couple of the other companies like Mastek have said that, yes, there are delays in client spending, but no cancellation in deals just yet. What do you do at a time like this? Do you stay put with your IT investments, or do you churn out?
Well, a couple of things I want to point out is obviously that the IT sector is exposed mostly to the US. And if the US were to get into a recession, we will have a short-term situation. But what would happen, as I think, personally, I think if countries get into a recession and companies have to really tighten their belts, you're going to end up using more technology. So in terms of technology, I think the kind of usage of technology cannot go down. It, in fact, has to go up to cope up with recession and other things. Yes, there will be delays in orders. The best way to play the sector is maybe go slightly long and sell out the money, because a lot of these IT stocks are available in the F&O space. I think you can start by either selling puts on these stocks or sell calls after buying these stocks. So a safe way to play this sector, it's off 30% of its peak. We might lose another 10-15%, but after that, I think we will stabilize. And these are all debt-free companies. So, that's the big comfort there.
Debt-free, in fact, forget debt-free, they are rich in cash and they are returning a lot of money to the shareholders. Infi, for instance, has a policy of returning 85% of its free cash flow over FY20 to FY24. They've just announced that buyback, which is currently ongoing and open right now. So they are rewarding investors as well. And that, of course, is a big play, this dividend play, buyback play for IT companies. Rajesh, so the big theme in the next 6 months is going to be China reopening. Now, there are many companies with linkages to China. So whether it's Tata Motors here, specialty chemicals, etc. What is the best way to play, tactically at least, any of the Indian companies to play this China reopening theme? What are the implications, according to you?
The best way to play China is to use your LRS money and buy some China funds, honestly speaking. It's very difficult to try and predict, which of these companies is going to benefit with the China opening. Yes, JLR might benefit, but there's intense competition in the Chinese markets. We've just heard the Skoda CEO saying that China markets are very, very competitive and they're planning to get out of China. So I don't know if there's a direct benefit or direct correlation with China opening and some of these Indian companies. What best we can do is look at companies that are exporting to China, not necessarily having plants in China, but exporting to China, whatever products. If China opens
companies up... which are exporting to China?
Yes.
Which are these companies? Could you give us some indication?
I don't have offhand data. You asked me this question, so I'm saying individual investors or mutual funds or whoever is an investment advisor can look at that and invest in those companies. But the best way to play China is, unfortunately, to use some LRS money and buy straight into China.
All right, got it. That is on what's going on with China and how you could play that theme. Rajesh, the other space I want to ask you about is PSU banks. We've seen a mad rally going on over there. It's 100-150% kind of gain this year. Do you think there's room for any significant upside from these levels as well? And would it be a good bet if you're planning to put some fresh money to play?
So a lot of the historical undervaluation has been, that gap has been covered. PSU banks are still relatively cheaper to private sector banks. But having said that, I think you've got to give a discount to anything in the PSU space, because government policy can change. We've seen it in the past, and it always hurts you to absolutely get over bullish on the government's policies. So from that point of view, I think there's a little bit of a caveat. Having said that, I think the Indian banking space, I've said it before, is at its best health that it's ever been. So in the past 15, 20 years. So from that point of view and credit growth point of view, I think you're going to see continued optimism. But yes, the kind of heady gains that you've seen of the past will definitely be tempered.
Okay, I do want to ask you about what's happening with the defense space as well, because, two companies in the last 48 hours, Bharat Forge as well as BEL, have indicated to us that there are huge orders coming through in the defense space, even within railways. Bharat Forge just secured a big order in Europe as well for artillery guns. Is this a space that continues to see upside despite the premium valuations?
So there's obviously the Make in India theme that is giving a tailwind to this sector. The problem is your customer is going to be one or two really big people. And we've seen this with infrastructure companies in the past. They've got fantastic order books. But when it comes to realization of payments, they get into all kinds of problems. And they have to file suits, legal tangles. And even after that, realization of these monies is difficult. So I think it's good to play that theme. Whoever's got it early is going to come out with big gains, but I would always be wary of valuation. So buy a company at a reasonable valuation. It's just a thematic buying into anything at any valuation does not make sense.
Just to get back to the point about PSU banks, you said there is value, which is, which is currently being offered even after the run-up, but you still sounded a bit cautious on it. So should one buy PSU banks or not?
I'd say if you are invested, stay invested, maybe 10-15% more, just for the fact that in a relative sense, they're still undervalued. But the kind of undervaluation that we've seen in the recent past is no longer there. So anytime you have a little bit of discomfort in the BFSI space, I think PSU banks will be the first one to take that hit. So you've got to keep that in mind, that the PSU space can be volatile, and if things go south, then they are the first ones to take the brunt.
Okay, all right, we leave it at that. Thanks a lot for joining in and giving us an update on the markets as well as the sectors that you like and you are cautious on. Let's slip into a short break. When we return, India's largest winemaker Sula Vineyards IPO opens for subscription today. We get you excerpts from our conversation with the management after this break. Stay tuned. Okay, welcome back to Trading Hour on CNBC-TV18. For now, very, very quiet for the market. You just have to say the only standout feature is that IT stocks continue to be on the downside, with emphasis on the back foot this afternoon, as well as on the upside. You have a lot of these consumption names, Nestle India, and some of the pharma names, Dr. Reddy's, Divi's, that are doing well. But there's a new IPO in town, and it's India's largest winemaker, Sula Vineyards. The 960 crore IPO opens for subscription today. The price band is 340 to 357 rupees, with an implied market cap of 3,006 crore rupees. Earlier at the company's press conference, our colleague Yash Jain caught up with the MD and CEO Rajiv Samant to understand the outlook going ahead. Listen in.
What does this ultimate plan of increasing the capacity take your total capacity to? Eventually, where do you see it in the next 2 to 3 years?
So we'll go from 14 million to 20 million liters.
Okay. Speaking about the debt, slightly less than about 200 crore rupees. What does that give a debt to EBITDA for the company as of now? And when it comes to that debt, what are your plans? Do you plan on sort of deleveraging further? Or considering the capacity that you want to undertake expansion there, does it go a little over 200 and beyond?
So at 200, which is give or take our current level of debt, we are looking at a debt EBITDA of less than 2.0.
Okay.
So it's a very comfortable ratio. You know, during the depths of the pandemic, we had gone to 6. I don't know how we dealt with those days. But, you know, we had always said that at 3.0 and below, we are comfortable. And today we are less than 2.0. So I think that even from our own internal metrics, we're very comfortable with that.
Would you say that you have a headroom to go till 3 and that could happen considering the...
I do think we have a headroom, but there's no plan for that right now. So there's no plan right now to take on any major debt.
If you want to sustain these kind of margins, 25-26%, do you think it'll be advisable, it'll be the right thing to actually sort of try to balance it from wine tourism business also, as much as you focus on the wine business? What's the plan there? Do you sort of expand the tourism side as well, and in what ways then?
I think we've reached a great place already. So I'm very pleased to say that in H1 of this financial, our EBITDA margin is in excess of 27%, which is unprecedented for us. Our best ever H1 before that was around 16-17%. So you can see that the margin is very much sustainable, seems to be expanding, but that's not necessarily our goal. Our goal at this point is to sell more wine and bring more wine to more people in India. That's now, I think we feel very comfortable with where our margins have reached. I'm not saying that they will not go up further, that's possible, but I am saying that I'm quite confident that they're not necessarily going to go down.
The FTA ratification, now you did give me an explanation that it sort of impacts the category which is the costlier side of wine and not right now the portfolio that you have. Do you still stick to that statement that in the form that it's turning out to be, it will still impact the lower category price range products and not, it will impact the higher category price range products and not the lower ones?
Absolutely stick to that. That's the way that it has panned out. That's the way we see it right now.
Okay, that is Sula Vineyard. It's also the pioneer of wine tourism in India. The first wine tasting room is credited to Sula Vineyard, the first vineyard resort, the first wine music festival, the first, the tours which take place at Nasik. So, apart from, of course, being one of the best known wine companies, manufacturers in India, it's also helped a lot in terms of wine tourism. Get into a break. We'll come back with more on the market.
Welcome back. You're still tuned into Trading Hour, and one stock which is in focus today is Paytm. This is after they put out their November business update. So Abhishek is here with the details. Abhishek?
Well, Pavitra, just calculation for the month of November shows that the number of loans disbursed on a month-on-month basis is up 0.12%, while the value of loan disbursed on a month-on-month basis is up close to 6%. So coming on to October plus November business update, the number of loans disbursed is at 68 lakhs, up about 152% on a YY basis, while the value of loan disbursed has grown by 374% on a YY basis. So the gross merchandise value is at 2,28,000 crores, which is up 36.5% YOY. However, calculation shows that for the month of November, the gross merchandise value might have declined from the level it was in the month of October. So calculation also shows that the gross merchandise value per MTU, which is the merchandise trading unit, is up about 2.5% on a YOY basis. So November was a softer month when compared to October for Paytm. Back to you.
Okay, thanks a lot for that. So that is as far as Paytm is concerned. The stock is still under pressure though, down almost 15% in the last 1 month. But for the market, very, very quiet, not too much happening, absolutely flat for most key indices. So with that, we will wrap on this edition of Trading Hour. Do stay tuned in though, halftime report comes up next.